Welcome to the AWA Market Minute, breaking down current economic, financial, and political events that impact today's retirees. Our investment committee performs hours of research and analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring investment advisors Jaron Monk, Mason Page, Chief Investment Officer Scott Hoxer, and your host, founder and CEO Paul Coles.
Well, welcome everybody to this month's edition of the AWA Market Minute. With me as always, we've got Scott Hoxer, our Chief Investment Officer. I'm Paul Coles. And we're excited to be with our clients and friends again this month and start out our 2023 kind of schedule of events. Just a couple quick housekeeping items. These market minutes that we do every month for 30 minutes are designed to be educational in nature. They're designed to be kind of a generic audience and information that's more for the masses. They're not designed to be specific investment advice for you one-on-one, and we would encourage you to meet with your advisor here at Alliance Wealth Advisors for that specific application to you. And so with that, Scott, I had a fun conversation this morning. My 13-year-old son is currently studying Spanish.
All right.
And he has a Spanish test today, and so he asked last night if I would get up early with him this morning to help him study for this test. And so the test is on the gustar verb, which means I like. Well, kind of it means that. It actually technically translated means it pleases me. And so that was the subject was this verb gustar and its utilization. Anyway, so I wake up early with him this morning to do some kind of pre-test work. I'm a little embarrassed to admit that he hasn't really asked me or engaged me for help. I speak Spanish fluently, but I've just assumed he's been working through the curriculum on his own because he hasn't asked for help. And this morning, as we kind of dove into the material, I realized, we had some big gaps to fill on his comprehension of Spanish. So the point of my story is this: we get into the lesson on how to use this specific verb gustar, which kind of appears as a reflexive verb because of the way you would use it, and there are indirect object pronouns that you use instead of direct object pronouns. But I explained to him that it's not actually a reflexive verb, but that it appears that way because you would conjugate the verb for the object rather than the subject, because technically translated it means it pleases me. And so I explained all this to him, and he looks at me and he says, "What's conjugation?"
You lost me at reflexive.
I know. So I said, "All right, bud, we gotta bring it back a little bit to like day one, lesson one, and we got to talk about verbs and nouns, and we got to talk about how to conjugate verbs and what that even means, and then we'll give you some context to be able to understand this subject a little better." And as we got into that, it hit hard to me that he needed to really understand and memorize the most basic application of this. And we just drilled it, and we drilled it, and we drilled it, and I explained it simply, and we drilled it, and we drilled it, and we drilled it, and I re-explained it simply. And probably by the fourth or fifth or sixth attempt, I could see some comprehension really setting in, and then I could build on that comprehension. Yeah. Okay? And so it kind of got me thinking, repetition is the motor of learning. And this is a principle that is very critical in every area of learning, is we have to repeat that thing over and over and over again. And I knew today, in the context of what we're going to talk about with our guest that we're going to introduce in a moment, that we needed to kind of do a good job of explaining what this guest was going to speak to in context of our clients' investment portfolios. And so in the spirit of repetition being the motor of learning, I want to actually have a conversation similar to the one we had just in our last market minute. Andrew, if you wouldn't mind sharing that slide with me. We talked about this idea of the psychology of investors, and everybody is exposed to the emotions that come with investing. All of us are. Scott and I are. All of our clients are. We know that there's cycles that we go through every time the market, when we invest, there's market cycles, and they exist. and we know that we will experience highs and lows during those market cycles. And I won't spend a belabor this point because we did this in our last meeting, but you go through a series of emotions, and we generally recycle those emotions during a standard market cycle. And the point that I wanted to make is if we zoom out and we have been both one, financially able, and two, emotionally able to withstand and weather those emotions, we are entitled to a return from our investment, right? When we are both financially and emotionally able to kind of withstand the emotions that come in investing, then a return comes. This happens to be the zoomed out version of that emotional cycle. Over the last 6 years, we see a 13+% rate of return. If we zoom out one more time and we look at a 20-year period of time, now we're looking at north of 11%. And so this is some of the the rewards that we might receive for being willing, both financially and emotionally, to weather these storms. We talk about the emotional components of that, but the financial components are very specific. What that speaks to is if I've got all my money invested in the specific strategy and the markets are going down and I have to take a withdrawal in order to finance my vacation or my car, then I'm not financially able to weather these kind of cycles, right? I can maybe emotionally handle it, but maybe I'm not financially. So we need both elements, both financial and emotional. So that's where our firm really drills home this concept of smart retirement. And again, in the spirit of repetition, these are the buckets that we want our clients to use. Now, these are kind of the general principles and guidelines that we adhere to as we construct a client's portfolio for retirement. Every situation is going to be a little unique one-on-one, and so this might not be perfectly applicable to everybody on the call today, but these are the general rules and guidelines that we adhere to as we kind of construct a retirement plan. So the first bucket is spending, and this is the money we leave behind in your preferred bank or credit union. This is where you'll live from. You'll spend from here to buy your next car and buy your vacation. And the amount should be equivalent of between 50 and 100% of your annualized spending. So if you forecast $100,000 a year spending, you really ought to keep in this bucket somewhere between $50,000 and $100,000. The next bucket is protected, and this is a bucket where we will leverage a financial institution similar to that of a spending bucket, but the difference here is instead of putting our money on deposit, we actually lend the money to the financial institution, and this amount should account for anywhere between 150 and 300% of our annualized spending, but not to exceed between maybe 20 and 25% of our investable assets. Here we give up a little liquidity in exchange for a little better potential rates of return. And finally, the last two buckets are what we call defensive and growth. And this is the money that we invest in the market, right? Defensive and growth is when we take a position in the market and we've given up any kind of relationship with a financial institution, giving us any kind of a guarantee. In exchange for that, we've assumed the risk of owning something. And where these two differ is in the different investment selection committees that we employ to make decision making. We talked last month with one that we've worked with a lot, and it was Poland Capital, Dan Davidowitz, and their whole concept is do a lot of research on the underlying securities and be very fundamental in your approach to why you would own what you would own. And this is a buy and hold strategy. This is buying good quality equities and holding them for good long-term periods of time where we can see the fruits of our investment over time. And their research and due diligence and analysis on the underlying fundamentals of these companies is where we really get rewarded for their labors. The one we're going to talk to today is a little different than that. They're not looking at the individual securities. They're looking more at the macro information available on the market and the economy. And rather than kind of having a buy and hold approach, here we're looking more specifically at windows of opportunity where we might find entry and exit points into the market, with the underlying objective being win by not losing. We want to try to create an approach that says we want to get some volatility protection and specifically some downside risk mitigation. And so this is what we call our defensive bucket. And the application here, and I know we've drilled this with you guys many, many times, but in the spirit of my 13-year-old learning what conjugation means about Spanish, you'll have a spending bucket. And if you spend out of that spending bucket, we'll refill that spending bucket. And depending on where we are in that market cycle, we would potentially refill it from a red bucket, or we could potentially refill it from a yellow or green or some combination thereof bucket, with the goal of dynamically selecting which macro asset we pick from so that we can allow the other invested assets to do what they're intended to do over periods of time. The whole concept here is, and Andrew, you can kill this slide. The whole concept here is we give our clients permission through smart retirement to sleep when the wind is blowing outside, because they know their affairs are in order. They've gone outside and pulled in the garbage cans, and they've kind of battened down the umbrella. And when they're woken up in the middle of the night from a pretty breezy, gusty storm, they don't have to run out in the middle of the night and panic and say, what do I do to react to this? Because they've already done the preparation work to know that their affairs have been taken care of and their retirement plans have been organized. This is what we call an all-weather strategy. We're not trying to build something that we react to, every time more financial information shows up. We're trying to build something that works for the duration of the retirement.
Yeah, yeah. And I think it's important to draw the distinction, Paul, between that red and yellow money, as you have done, right? They're both invested in the market, but very distinct approaches. Dan, who we spoke with last time, who manages a growth strategy, his focus is on opportunity. He wants things to grow, appreciate in value, take wise risks, and make a lot of money over the long run. The defensive managers we have could not be more different. They look at markets and they say, what could go wrong? What could kind of blow up in our faces? And what can we do preemptively to protect against that? So it's a very different approach to investing, and a good portfolio has a little bit of both.
Has a little bit of both.
Yeah.
And so when clients call and say, this information is happening, how are we reacting to it? We point to the yellow buckets.
Yep.
And if they say, well, why aren't we doing that with everything? We have to re-explain smart retirement. Some of your money needs to be invested not just for this 6-month period, but for the next 6-year period.
That's right.
So with that, Scott, should we introduce our guest today?
Yeah, let's kick it off. So it's our pleasure to introduce Fritz Foltz. And we've had Fritz on before. Fritz is a dear friend of ours and someone who we really value as a partner in this industry. Fritz has great investment insights. He's been in this business for decades and adds a lot of great color and perspective. So Fritz is a managing partner at 3Edge Asset Management. He's also the chief investment strategist. And 3Edge comprises a component of many of our client portfolios. And 3Edge weathered the storm extremely well through the 2022 downturn. So Fritz, pleasure to have you with us. Thanks for giving us a little bit of your time. Let's kick it off with maybe just a kind of Cliff Notes version of, for total return specifically, how that strategy is kind of employed and put to work.
Yeah, sure. So, as you mentioned, we weathered 2022 well. We were at our minimum in terms of equities, and we're actually at our minimum in terms of traditional fixed income as well, gravitating more towards very short duration treasuries and floating rate. So the total return strategy is a strategy which, to talk about your yellow bucket, it really is a safety first strategy, exactly as you said. And, we feel that we can make a good rate of return if we are able to, and you can't time the market, right? But what we try to do with a total return strategy is lean in one direction or lean in another direction away from where we see a heightened level of risk, where to us, our risk reward, which is more conservative, we might feel. So for last year, we became defensive near the end of 2021. And as you remember, the market was going up smartly, there was reaching record highs. And so it was somewhat contrarian to become defensive, but we saw the yield curve was flattening. We saw inflation, which we thought would be more problematic and less transitory, at least than the Fed. And so we saw these indicators, which indicated to us we needed to become more defensive in terms of our equity exposure. And that paid off very, very well. So when we do our analysis, we look at 3 different components of our research. We look at valuations, right? And that's a very long-term indicator. And to put that into perspective in terms of what we did last year, our model was telling us that US equities in particularly were very overvalued going into 2022. So that was one reason, not sufficient unto itself, but that was one reason to be cautious. Then we look at economic and market fundamental factors. So one of the things that we saw was the flattening of the US Treasury yield curve. So you were in a situation where short-term interest rates were starting to rise up and long-term rates come down, and the yield curve, the difference was becoming quite flat. All else being equal, doesn't necessarily augur well in terms of what things that could transpire in the economy and in the markets. And then from an investor behavior standpoint, we just saw that the market had sort of just assumed this levitating, if you will, a bit, where investors were just buying because other investors were buying. So if we looked at all three components of our research, that to us was an indication that it was time to become more conservative in the total return strategy. And I like very much the way you explained it, because that's exactly right. We're not going, if in a market like 2021, we're never going to keep up with a firm like Poland Capital, and we shouldn't do that. But where we really earn our stripes is in a year like last year, where we can help smooth the volatility of the overall holdings in a multi-manager approach. And so that's what we were able to do last year. And so that's how we look at the total return strategy. We have those three components of our research, and it really is a safety first, smooth market volatility, and avoid those really big downturns. And the benefit of that for us is we don't have to dig ourselves out of a hole if the when and if the market starts to go back up. So hopefully that's a decent overview and not too much.
Yeah, I like that a lot. Thanks, Fritz, for kind of walking us through that. And your strategy has a kind of machine component, if you will, and a human component as well. Maybe walk us through how the algorithms and kind of machine side of the house drives decision, and also how human intervention steps in as well.
Absolutely. So all of our investment research, we use no Wall Street research. All of our investment research is based on our proprietary model of the global capital markets. So we have a quantitative model that we've developed over a 40-year period. But what that model does, it's not a black box, but rather what we've tried to do is understand what we believe are the real cause and effect relationships that drive the markets. And so it's those three components, right? Valuations have an effect, economic and market fundamentals have an effect, and investor behavior has an effect. So what we do is take our best theories about how those three components impact the markets and then simply express it in a model. We all have models, right? Most of the time it's in our head, but for all the things that we need to keep track of, you just can't do it. So really the way to think about the model is it's really where it houses all of our best theories about what the true cause and effect relationships are that actually drive the markets. So the model gives us an output, and the model runs 24/7 on Amazon Web Servers. We're running on 2 of those. And every day we see what the model output is. And it's telling us what asset classes are ranked more favorably, what asset classes are ranked less favorably. Now, we're not acting on that because we don't make that many changes, because it just simply wouldn't work. But we also don't just translate the output from the model into the portfolio. There is, as you mentioned, human intervention. And the reason is you have to be careful with a quantitative model, because you can go down these rabbit holes and make investment decisions that, quite frankly, we would look at as experienced investment professionals. We have over 100 years of experience. I'm old, so we have lots of experience, and it has to make sense, right? You could look at something and say, well, the model's telling you to do this, but we might say at the investment committee, well, wait a minute, that does not sound like it makes a lot of common sense. And the good thing about our model is if we have that thought, we can go back into the model and see exactly why the model is telling us what it's telling us, because it's built on our theories. Now, many quantitative models are in fact black boxes, and the investment committee doesn't care why the model is telling it to do something. But for us, we don't like that. We want to know why the model is telling us why it's telling us a certain thing. And if we question it, we can go back in there. And, we can always also override the model if it doesn't make sense. We believe that human intervention is very, very important. Now, we don't override it very often, but it's there. We want to just, give it the smell test, if you will, to make sure that it makes common sense. Sorry, that was a long-winded answer in terms of the model.
That was great. We call that a sanity check, right? Just
Yeah,
making sure that what this thing has told us to do seems correct. When I was in statistics back in my finance classes, they talked about some kids who ran some model calculation of miles to the moon, and they goofed up one of their variables and reported back a number that was like a billion miles off, but they didn't do a sanity check first, right?
Right. Yeah.
So Fritz, let's maybe change gears a little bit,
Sure.
and with the insights that you have, that Steve has, interested in kind of what your outlook is with rates and inflation specifically. Those were the primary drivers of the market last year. What's your outlook for both rates and inflation in 2023?
Yeah. So great question. I mean, that's what everybody really is focused on: interest rates, focused on inflation. And I think that will continue. And so the way we look at this is we do believe that we're going to see inflation come down, that we've seen peak inflation, and, inflation is going to come down. And, as we know, interest rates have gone up dramatically. So if you look at where interest rates were, basically 0 to 1%, now we see interest rates are much higher. So what we could see is inflation continue to come down, and we could even see interest rates in the longer end, in the longer maturities, also come down here for a period of time. Our concern is that inflation could come down, but it may not be able to get down to that 2% target that the Fed has, because there are components of inflation that are just stickier, right? Wages, wages have gone up, and those don't, they're not going to adjust back down quickly, or rents, or owner equivalent rents. So there are components of inflation that may not get to that 2% target. And so then at that kind of a moment of truth that we're going to experience, and then the Fed is going to have to decide, do we want to take the steps necessary to really bring inflation down to that 2% target? Or can we live with a higher rate of inflation? And the reason they would think about that choice is they don't want to push the economy into a recession. So we think in the short term, in the months ahead, inflation will come down, long-term interest rates might come down as well, but we're going to reach this moment of truth. And we'll see where the economy is then too, right? So we're going to start to get indications as corporations, beginning actually on Friday, start to report corporate earnings. And we'll see if it looks like those earnings weren't so great in the fourth quarter. Maybe their forward guidance is lower. And so we'll see how strong is the economy when inflation gets down to that certain, maybe it's 3%, 4%. And then that's a tough spot for the Fed, because they're going to have to make the decision of whether they want to push even further to get inflation down to 2%. Or do they have to, back off a little bit because they don't want to push the economy into a recession. So short term, we think inflation and interest rates come down. Long term, less clear as to where we go.
Yeah, it's an interesting time, and to your point, Fritz, we're going to get some good economic data this week. We'll get the inflation print tomorrow.
Right.
The big banks will report earnings on Friday, so we'll get some more data to kind of work off of. And I think an important thing for our audience to realize, Fritz mentioned recession. The market is usually a leading indicator, right?
Yes,
so the market
absolutely.
will bottom out before markets. So we can have plausibly a scenario where we are in a recession, but markets looking forward, have started to rally. But thanks for kind of walking us through that, Fritz. Walk us through something that I think is an elevated risk relative to what we saw even 4 or 5 years ago, and that's geopolitical risk. I think with the war in Ukraine and some of the other developments around the globe, geopolitical risk is a heightened risk for investors. And how does 3Edge think about geopolitical shocks, geopolitical things that come out of left field? How do you guys kind of prepare for and respond to those situations when they arise?
Excellent question. And this is a very important, this is really key for us, because the first principles for us would be that it's really important to have planned and prepared and constructed your portfolio before you have events that, really can come out of nowhere, and they call them a black swan event, an event that's very hard, if not impossible to predict. So you want to, in our estimation, the way I think about it is we want to construct what I might call a 4-wheel drive portfolio. So whatever we may encounter on the road, maybe it's a really big pothole, or, maybe it's, Russia invading Ukraine. Maybe it's China pushing, doing something overtly aggressive in terms of Taiwan, or something that we can't even think of. So when that happens, before we would react, that's why we will always have a minimum of our portfolios invested in gold, because gold is a very good shock absorber kind of asset. And when you have a difficulty in the world that may come on very suddenly, people will flee to that quote unquote haven asset like gold. We also always carry some amount in US Treasuries, because again, it's a haven asset. It's a place of safety that investors will go to when you're in a time of crisis. So that's the first step, is to have a foundation before these things happen so that your portfolio can withstand those first initial shocks. And then, if we're perfectly comfortable just taking risk off the table and reducing our risk from there. But I think the key and the way to really weather these storms is to be prepared for them in the front end. And again, that's not something that Poland Capital would do, but since we're safety first investors, that's very much part of what we do. That's why we're in the yellow bucket. We're thinking about those potential eventualities, which means that we're always talking about depressing things that could happen in the future.
No, that's great. I have a quick question. So bonds just wrapped up, one of the worst, years in bond history, and that's not hyperbole. What is your outlook for bonds generally, and what role will they continue to play in your portfolio construction?
So first and foremost, we'll always have some minimum amount in US Treasuries, as a measure of safety in the portfolio. Now, but the way we'll think about bonds is very much related to inflation, which makes sense. We think that, if we continue to get good news in the front end of 2023, we could see particularly long yields in the longer end of the Treasury market come down. But this is important in terms of the way that we look at the world. What we've seen, since the financial crisis in 2009, coming out of that, we have gone through an incredibly long period of easy monetary policy, of very low interest rates, of very low inflation, and quite frankly, very low volatility. We believe that what we experienced in 2022 is not a short-term phenomenon. It is a shift. It's a regime shift. And that the days of 0% interest rates, we don't think we're going back there anytime soon. So we believe that we will be in an environment where inflation will be higher for an extended period of time. And that's a real difference from what we've experienced. And so we will remain invested in treasuries and in bonds. It's an important part of what we do for protection, but we're going to look more towards perhaps treasury inflation protected securities. If we feel, because we feel that the market doesn't necessarily appreciate yet how much inflation is going to remain embedded in the system. And so if that is in fact comes true, then inflation expectations will need to go up. And as they do, you'll be rewarded for being in Treasury inflation protected securities, which, they're US Treasuries, but they provide the benefit of adjusting the principal of the instrument at the rate of inflation. And so that's a switch from us, because those didn't make sense, in the decade plus from the global financial crisis. But now we feel that, we're going to go from a low inflation, de-inflation, to a more moderate inflationary environment for an extended period. So we'll need to adjust our fixed income. We'll look at tips to do that. But at the same time, we'll always hold some amount of nominal US Treasury securities. We're really conservative. So we're not hugely involved in the corporate credit market. We feel that, we could see, if the economy really starts to slow down here, if earnings start to decline, we could see issues in the corporate credit market and credit spreads, the difference between investment grade and lower rated bonds could widen out and create a problem. I think if you're in the investment grade credit area at high ratings, you'll be fine, but we're so conservative that we just don't feel that the risk reward there for us makes sense. So we'll stick with the treasuries.
That's awesome. Thank you. We probably just have time for maybe one more.
Yeah, so you touched on this a little bit, Fritz, but one of the things that we like about 3Edge in portfolio construction is you add things like gold, you add things like real assets. You've had some exposure to commodities specifically over the past year. What's the outlook, Fritz, for commodities? Things like lumber and oil and kind of real hard commodities. What's the outlook for those generally in 2023 in your view?
Sure. So we do. We're pretty bullish on real assets in the long term. Gold was interesting last year. We were at or near our minimum throughout the year, but gold was down less than 1% last year by the end of 2022, and relative to a lot of other asset classes, that's pretty good. But so what we saw last year though was we saw real rates. Right. Nominal interest rates adjusted for or less inflation, they were actually negative, right? They were at like minus 1% because they were below the rate of inflation. Real rates are back up at about 1.5%. And so what we feel is, and when that's very difficult environment for gold. So, but we feel that now real rates at this 1.5% level are probably going to level off, are going to stabilize. So we like gold again. We also, if you think about safety first, gold is a very good holding and the dollar continues to come down. The dollar has been so strong for so very, very long. We believe that there's a good chance that the dollar, which has come down starting in October of last year, that could continue. And a weaker dollar is also good for holding gold. Can I explain the way we think about gold briefly? So oftentimes I say, okay, how do I think about investing in gold? And what I say is, okay, let's just say you buy a bar of gold. You take that gold and you put it on the shelf. It doesn't do anything. It doesn't pay you interest. Unfortunately, it doesn't pay a dividend. It just sits there. It doesn't tarnish. It's been there for a long, long time. But what changes is the amount of paper money that it takes to buy that bar of gold. And so if you think about it, if the dollar comes down in value, the inverse of that is that the price of gold is actually going up because it's taking more and more of those dollars to buy your bar of gold. So based on the fact that we feel that the US dollar is ripe to continue to come down and weaken here, we like gold, and we've recently added a little bit more to our gold holding to take us off the minimum. In terms of commodities, we've seen commodities come down, frankly, because the price of oil has come down so much, right? And part of that was because that the U.S. government dipped into the Strategic Petroleum Reserve and used that oil so that people weren't paying exorbitant prices at the pump. And so oil came down, commodities came down. Well, they're going to have to refill that Strategic Petroleum Reserve. And so we could see the price of oil start to move back up. That would be good for commodities. There still are issues around food and agriculture based because of the invasion of Ukraine by Russia. As we know, that really mucked up the works because Ukraine was such an exporter of food and grain to the rest of the world. And so we see that there could be shortages. We have severe droughts and severe weather. And so we're positive on commodities, longer term, value of the dollar coming down, shortages of commodities, price of oil going up. So we may start to add to our commodity positions as we get further into 2023. But for real assets, the first move we made was to just increase the amount of gold that we held.
That's great.
Yeah.
Yeah. Any other questions? You feel like we've covered most we need to?
No, I think we've covered kind of the key points. I mean, as always, Fritz, really appreciate your insights.
Yeah.
Well, thank you.
Fritz, I think it's extremely beneficial for our clients and our audience to be able to, hear directly from the source, some of the insights and perspectives and outlooks that are directly involved in making decisions around part of their retirement accounts. And so we appreciate you taking the time to be with us today and explain some of that to our clients.
Not at all. And in honor of your 13-year-old, I'd like to say that a mí me gusta mucho hablando con ustedes.
And you even used a gustar verb, which is like
Yeah.
right in context. The whole full circle, Fritz. I think that deserves an applause. So
Thank you, guys.
listen, we appreciate you. And for everybody, all of our audience who's on the call with us today, thanks for joining us for this month's Market Minute. Just in closing, make sure that we understand that this is designed for a general audience, broad and educational in nature. Not specific to anybody, and feel free to reach out to your team here at Alliance Wealth Advisors to talk one-on-one about how this applies to your portfolio. And until next time, next month, we'll plan on seeing you guys again. Thanks, everybody.
Thanks.